Here are two trades. One is expected to return 9.5%, the other 12%. Obviously, you take the 12. But the professional takes the 9.5 because they aren't looking at return. They're looking at return per unit of risk, the Sharpe ratio of a pair's trade. Today, we calculate that unit. 8 parts in, the foundations are done. We built a spread, we learned to run it, and last time we learned to read it. And honestly, you could stop here and still trade this, but the author of the original material opened the advanced series with a line worth taking seriously. He wrote that the basics alone leave a lot missing when it comes to understanding what pairs trading actually is. He's right, because there are 2 sentences we have been saying out loud for 8 parts without ever backing them up. The first, pairs trading is market neutral. The second, even so, risk remains. Both are true. But we have never proved why the first one is true, and we have never measured how much the second one is. Today, we do both. 3 steps. First, theory. The equation for a pairs trade falls straight out of the capital asset pricing model, out of CAPM. Second, proof. You are going to watch the market vanish from the algebra. Third, measurement. The risk of a pair compresses into a single number, and with that number, you decide which pair to buy first. One framing before we start. Broadly, there are 2 camps in investing. The camp that emphasizes psychology and the camp that emphasizes probability and statistics. Pairs trading is market neutral, so market direction and sentiment matter less to it, which puts it, necessarily, in the statistics camp. That's why the advanced series digs into the statistical properties of the spread itself. The Sharpe ratio for pairs trading is where the first 3 steps get paid off. Step 1. Theory. CAPM, the capital asset pricing model, says something simple about what you should expect from a stock. The expected return on a stock is the sum of 2 parts. Expected return equals the equilibrium return plus an extra return. The equilibrium return is the market's expected return multiplied by that stock's beta. It's the return that sits on the security market line, the amount this stock deserves, given how sensitive it is to the market. And the extra return is whatever sits above or below that line. It comes from something specific to the company, and here I'll use the author's own phrase for it. The part that cannot be logically explained. That extra return does real work. If you expect it to run above equilibrium, demand rises, the price rises, the stock is undervalued. If you expect it below, supply rises, the price falls, it's overvalued. Now here's where it gets interesting. Take that equation, convert it to log returns, and write down what happens when you buy a stock at some point in time while simultaneously selling the index in proportion to that stock's beta. Rearrange it. And what comes out is the spread equation from pairs trading, the one we built in part 4. And what that equation tells you is this. The difference in the spread is your expected profit. If the spread was minus 10% when you entered and plus 5% when you closed, your profit is 15%. One more thing here. In this derivation, beta and the cointegration coefficient are the same object. Beta is sensitivity to the market. The cointegration coefficient is sensitivity to the other leg. When the other leg is the market, the index, the 2 are the same calculation. In part 6, we said you can pair a large cap stock against an index ETF. This is why that works. Let's push the CAPM logic one step further. According to CAPM, 2 stocks with the same beta should have the same expected return. In the real market, they don't. And wherever something should be equal but isn't, there's an arbitrage to think about. The method is the same idea as the standardization from part 2. Take each stock's excess return and divide it by that stock's beta. Return per unit of beta. You're putting both betas on the same scale so the 2 are comparable. What's left over tells you which one has run further than it should have. There's a trap in the direction here, and it catches people. A high expected return, looking forward, means the stock has room to rise. That reads as undervalued. A high realized return looking backward means it has already risen. That reads as overvalued. Same phrase. The return is high, and the conclusion flips depending on which way you're facing in time. The author ran this calculation on 2 real stocks, then compared what it said against the overvaluation he got from the pairs trading method. The two broadly pointed the same way. The two theories checked each other's work. They didn't land on the same figure, and the reason is mundane. The window he used to measure beta and returns was chosen arbitrarily. And now I want to hand you the author's own words, unedited. About this CAPM derivation, he wrote, there seem to be a lot of parts that are logically unclean. Applying an expected future return in one place and a realized past return in another is not smooth. I'm leaving that sentence in rather than deleting it for 2 reasons. 1, it's honest. 2, when you're learning a piece of theory, knowing where its weak link is helps you far more than a clean story does. Next step, and this one has nothing unclean in it. It's pure algebra. Step 2, proof. Back to the market model. A stock's return is 2 parts, the market factor times beta plus the company's own residual. Now, that residual is the company's character. With no long-running good or bad news, in ordinary state, the residual averages 0 and oscillates irregularly around it. And it has one property that matters enormously in a moment. Add a residual to a residual, and you get another residual. I should say plainly that a single factor model is a simplification. In reality, there are sector factors and macro factors too. That's what multi-factor models are for. We're using one factor because it's enough to show the thing we're about to show. Now let's build a portfolio. Buy 1 unit of stock. A. Sell H units of stock B. H is the hedge ratio. Write out the return on that portfolio and substitute the market model into both legs. The market return now appears twice in the equation, once positive from A, once negative from B. So here's the question. What value of H makes those 2 terms cancel exactly? H equals A's beta divided by B's beta. Put that condition in, and the market return term disappears completely. What's left is a combination of residuals, and residual plus residual is another residual. So what you are holding in the end is 1 residual. Look at what that means. This portfolio is built out of 2 individual stocks and nothing else. No index, no futures, no ETF, and it has no exposure to the market at all. You erase the market factor using nothing but 2 single stocks. That is a market-neutral model, the class of arbitrage strategies that aims for a steady return whether the index rises or falls. It's the mainstay of hedge funds, and pairs trading is a subset of it. And if you convert that same equation into log returns and tidy it up, there it is again. The pairs trading spread relationship. So the conclusion closes like this. Pairs trading is derived from the market-neutral model. Pairs trading is a market-neutral strategy. We could have waved at it and said, well, it's long-short, obviously, but there's a reason to do the work. In the author's words, so that you have conviction that doesn't waver psychologically in live trading. Now keep the conditions in view. That cancellation holds under a single factor model with the hedge ratio set exactly at the beta ratio, with betas that don't drift. In practice, it's an approximation, not a guarantee. But on the day the market is falling apart, what you're holding on to is not a feeling. It's this algebra. Let me clear one thing up quickly, because there hasn't been a natural place to say it until now. In the market-neutral model, we just use the ratio of the 2 betas as the hedge ratio. But in pairs trading, we use the cointegration coefficient as the hedge ratio. Are those the same thing? The formula is the same. The ingredients are not. CAPM's beta is computed from returns. A returns beta. Pairs trading's cointegration coefficient is computed from prices. A price beta. Same formula, different inputs, so the numbers come out different. For now, all you need to hold is that these look like the same symbol and are not the same object. Which of them belongs in the hedge ratio? That question gets faced head-on later in the advanced series, in parts 17 and 18. There is more than one way to compute a hedge ratio, and the choice changes your results. Step 3. Measurement. How do you measure the risk of a risky asset? With the variance of its returns or the standard deviation. If returns swing hard, risk is high. If they're placid, it's low. That's the definition Markowitz gave in portfolio selection theory in the early 1950s, and it's still the working definition. In practice, desks also use value at risk, VAR, which expresses the worst plausible loss as an amount of money. But when you're developing theory, you use variance, Build a portfolio out of two stocks, and the return is the weighted average of the two. The risk is the variance of that return, and there's one property in there that matters. If the two stocks move identically, the variance is just the weighted average, no benefit. But correlation is almost always less than 1, so the portfolio's variance comes out below the weighted average of the individual variances. That is the risk reduction effect. Diversification. Pairs trading differs in one respect, though. One leg is short, and that's where a fact turns up that most beginners never hear. If you buy both legs, your weights sum to 100%. But if one leg is sold short, borrowed, that leg costs you nothing up front, so the weights sum to more than 100%. Buy 100% of one stock, sell the same amount of another, and the sum is 200%, which means a pairs trade is already a 2 times leveraged position. The phrase market neutral sounds like a synonym for safe, but measured by exposure, you have twice your capital in the market. Sizing a position knowing that, and sizing it not knowing that, are two completely different activities. Now we calculate the risk of a pair. How do you put a short position into the equation? Straightforwardly, treat it as buying an asset whose return is the negative of the original. Put a minus sign on the second stock's return and drop it into the variance formula. And what happens? In the variance formula, the covariance term gets subtracted. That is the identity of risk in pairs trading. The two stocks move in the same direction, and you sold one of them, so whatever they share cancels out between them. In part 5, we said, in words, that the market risk layer gets peeled off. Here, that same event shows up as an equation, covariance, subtracted, and then a beautiful result falls out. The return on a pair's portfolio is the difference in the spread, so its variance is the variance of the difference spread, which gives us the line to remember. The risk of a pairs trade is the standard deviation of the difference spread. The author actually checked this on 600 days of data for two stocks. The value he got from the portfolio variance formula and the value he got by simply differencing the spread and taking its standard deviation agreed down to the decimal. Two completely different roads arriving at the same number, and the interpretation of that number is genuinely practical. Say it comes out around 1.7%. That means this spread moves about 1.7% on an average day. A large value is a high-risk pair, a small one is a low-risk pair, the risk of an entire pair compressed into one number. One last thing here. If the two stocks move closely enough that the cointegration coefficient comes out at 1, this risk term converges to 0. The risk cancels completely. Back in the foundations, I told you that a common and preferred share pair is relatively safe. This is why. Same company, so the two move almost identically, so the cointegration coefficient sits close to 1. What we asserted in words, the equation now explains. And it's the same statement as Part 8's rule that the safer pairs have coefficients near 1. Now, complete cancellation is a theoretical limit. In practice, residual risk remains. The coefficient drifts, the relationship breaks. But the direction is unambiguous. The closer that coefficient is to 1, the smaller your risk. Right. The cold opens answer, the Sharpe ratio is return per unit of risk, return divided by risk. Low risk and high return gives you a high Sharpe ratio. It's normally used to grade fund performance after the fact, but feed it an expected return and it becomes a tool for choosing what to buy next. One simplification, stated plainly, we're setting the risk-free rate aside here, which is how the original handles it too. Drop pairs trading into it and it's very clean. The return is the difference in the spread. The risk is the standard deviation of the differenced spread. So, the Sharpe ratio of a pair equals the spread difference divided by the standard deviation of the differenced spread. Now, let's run the two trades from the cold open. These numbers are illustrative. They're here to show the ranking, not to describe a real position. Pair A. The spread is currently at minus 9.5%, and we're targeting a return to equilibrium, so the expected return is plus 9.5%. The risk is 1.72%. Divide, and you get 5.52. Pair B. the expected return is higher, 12%, but the risk is 2.50%. Divide, and you get 4.80. A wins, with an expected return 26% lower, because to collect that 12%, B makes you carry 45% more risk. Per unit of risk, A pays you more. And look at what that changes in practice. In Part 8, we set up 2 monitoring screens, one for the portfolio you hold, one for candidate pairs. On that candidate screen, how do you decide what to put on first? Until now, it was a feel. From today, you sort by Sharpe ratio, 3 steps of theory, and this is where it pays out, 1 number to sort by. Let me pull it together. 4 lines. 1. The expected return on a pair's trade is the difference in the spread. We'd said that in the foundations, but today we watched the equation come out of CAPM. 2. The risk of a pair's trade is measured as the standard deviation of the difference spread. 2 different roads reached the same number. 3. The closer the cointegration coefficient is to 1, the smaller the risk. 4. Put that risk into a Sharpe ratio and you can rank your pairs, and rank decides what you buy first. And we got one more thing today. We saw, algebraically, why market neutral is actually true. Set the hedge ratio to the ratio of the betas, and the market term leaves the equation. On the day the market is shaking, the thing you hold on to isn't a feeling, it's that proof. That's the reason to dig into theory at all. Next time the question changes. Today we measured the size of the risk. Next, we test whether this spread is something worth trading in the first place. Does the spread genuinely have the property of returning to its mean? That's called stationarity. And is the distribution of the spread anywhere near normal? That second one matters more than people expect, because in the author's own words, even if the stationarity is excellent, a spread with poor normal distribution characteristics is not a good spread. The plus or minus 2 standard deviation entry lines we've been drawing since Part 3 rest on that assumption. And next time, the assumption goes on trial. One last word, and I mean it. Today was about how to measure risk, and it is not investment advice. Every number and every pair here was illustrative. No backtest, no recommendation. And the Sharpe ratio is a ratio built out of an estimate of past volatility. It ranks things for you. It does not stop losses from happening. The final call is always yours. If this was useful, a like and a subscribe help, and tell me in the comments. Up to now, when you picked a trade, were you looking at the numerator or the denominator? See you next time.